Most traders choose their stop loss randomly, 2% below entry, under the last candle, wherever it feels safe. But the market doesn't care about your feelings. If your stop loss ignores volatility, you're not managing risk, you're basically gambling with volatility luck. Today I'm going to show you a much more objective way to place stops using standard deviation, so your trades stay consistent no matter how volatile the market becomes. Here's the issue. Markets constantly switch between low volatility and high volatility regions. But most traders use fixed stop distances. Let's say your rule is 2% stop loss or 10 pips above the previous high, whatever it is. So that might work fine in calm markets where prices move up about 0.5% a day, 20% a day, whatever it is. But during volatile periods like we're experiencing now, assets swing 2-3% daily. There's 2 sigma events daily. That same stop suddenly becomes extremely tight. So that's why you get stopped out prematurely. So now you're getting stopped out constantly, not because your idea sucks, but because the market is noisy. So your results basically depend more on market conditions than on the quality of your strategy. So instead of guessing where stop should go, we can measure how much an asset normally moves, and that's what standard deviation does. Sigma, whatever you want to call it. In simple terms, standard deviation tells us the typical amount prices fluctuate around their average. Think of it as the market's normal noise level. So once you know that noise level, you can place your stop outside of it. So say a market moves about, 40 bips a day on average. That's the day-to-day trading activity. So if your stop is within that range, there's a high probability you're going to get stopped out regardless of your idea. But if it's, say, an extra 50 bips above it, then you're kind of protected. You can weather the noise and then watch your trade play out. So in this image, you've got euro dollar. The stop is basically above the previous high. That's his retail strategy basically. It's a fixed stop, ignores market volatility, expects a break, doesn't work out. But if you have a look on the right side, Euro USD has a 6.61% average daily move. That's about 73 pips, give or take. So we see price react as it does compared to this, but there's enough gap where it basically does what it wants to do before actually breaking. So instead of saying my stop is 2% away, you say my stop is 1.5 standard deviation away. 1 standard deviation away, 1 sigma, whatever you want to call it. This means your stop automatically adapts to the market. So when volatility rises, your stop gets wider, and when volatility drops, your stop tightens. Your risk becomes consistent across different market conditions. So this is the CVol tool on CME. Just Google it, it's gonna come out. This basically shows volatility of Euro USD compared to the price. So you can see volatility shift throughout the time frame. How long is this? 1 day. Okay, so that's really a short time frame, but we can basically see volatility shifting and price or the corresponding price moves. So if your stop basically disregards the volatility, there's a good chance you're going to get stopped out. That's a waste of money. So this tool is basically for oil, and that's the standard deviation I computed myself over 20 days. So you can basically do this by getting the daily return and log return and then calculating the 20-day standard deviation. If you want a guide on how to calculate it, I'm going to make a video. Just leave comments in the comment section. And this is a tool for investing.com. So you can basically go to investing.com click on Tools, Currency Volatility Calculator, and that's going to come out in red. Yep. So that's about the long short of it. Okay, let's go through a simple example. This is a very, very simple example. We've gone over it. So basically, this approach solves several major problems. First, it removes emotional decision making. So you're no longer adjusting stops because something looks right or something looks wrong. You want to give it more space, whatever, because you've already considered that before setting it up. Second, basically protects you from volatility regime changes. So there's a spike, well, 0.1 sigma spike, 2 sigma spike, and you can calculate that when setting up your trade. You go into a regime where you expect volatility to rise, then you set up your stop higher, or you increase the basically distance you get. So if it's usually a 1 sigma day, but you're expecting some volatility with some economic event, you can make it 1.5 sigma, 2 sigma, 3 sigma is really wide, but you know what I mean. So basically, stop loss isn't just a protection for being wrong, it's protection from market noise. Stop sits inside volatility, you're almost guaranteed to get stopped out randomly. And you go from having a good idea to basically donating, if you know what I mean. That's about it. So stay disciplined, risk management, and I'm going to make another video in about a second.